Hello, everybody. Welcome to Friday, another Talk Money with Tom show. I want to thank everybody for coming. This is a live show in Silicon Valley here, right? And so we're going to be answering questions today, and that's how we do the show, try to help people understand, retirement planning, money management, tax planning, and such in retirement. Again, even if you're not retired, there's a whole lot of things that you can do to start getting ready for retirement, how you're positioning your assets and those types of things. And obviously, if you're retired, there's a lot of things we can help you with too. So send in your questions. You can send them in two different ways. You can send them in via email at asktom@talkmoneywithtom.com, or send them into the chat here live on the channel, and we'll try to answer those live. We get questions during the week, so you can send them during the week also, and we get questions during our strategy sessions with our clients that we often cover in the show here too. So really, been doing this for quite a few years now. I really enjoy this process. Love to be able to help you out. We put this channel together, really kind of interesting. The first big video that we did was on the 22nd of March, 2020. Really, the market was down 35%. It was actually a Sunday. And what we were trying to do at that time was just, bring some calmness to the fear. There was both a financial and a physical fear and what have you. And point out some of the positive things that were happening out there. And it turned out that the next day, that Monday, the market hit its lowest point on the 23rd of March. And really, some of those positive points have been accurate and come out and continue to drive this. And so you can send those questions in, be happy to help you. And you can go to our channel and check out some of these videos. I do video every day of the market review. And then also we have all the pieces from the show, different questions. So you can subscribe, hit the bell button to get notified, and we'll be happy to continue to put content out that you can hopefully enjoy. And lastly, of course, you can meet with us directly if you'd like. Ethan and I are available. You can go to our book appointment button that's on our website. The link for the website's right here on the channel. Our schedule is live. You can set up a 30-minute, phone call or a video appointment, or come in the office if you like. So those are the processes. I hope everybody gets something out of what we're doing today. Very excited about some of the things that I've seen happen here. So I start off the show every time with a summary of kind of what I saw happening in the stock market. Because as an investor, as you either get ready for retirement or in your retirement, the more you can kind of understand about what's going on with the market, the better you get. Even if you're dealing with an advisor who's helping you with your money, really that advisor's confined by really your feelings about what's happening with the market. All right, so the more, that's one of the big things we do here, the more we can get people to kind of understand, the easier it is to help them get maybe better rates of return as far as that goes. So I'll start off here with just the old picture of where the market is. This is going back to 2019, and here's our summary. We've got that pandemic we just talked about. So right there at that bottom point is when we started doing these videos. And I think there's 1,500 videos on there on the channel now. But and so we've had this fantastic run up, and then inflation hit. We got a 28% drop. October 13th of 2022, we hit that low point, and really we've been going up ever since, right? Lots of ups and downs, including today.
Yeah.
I think it's down about 1.6, 1.7% as the show started here. However, this is coming off of an unbelievable run. Yeah. And I've been saying for quite a while that the market needs to have some rest here because it's really, I think, it's more stressful to me when the market runs without some kind of break. I just feel like, again, I always use this analogy of stretching a rubber band. So when you stretch a rubber band, it stretches pretty easy at first, but the more you pull on it, the harder it gets to stretch even farther. And so it's kind of that stress is almost like what I feel when you see the market going up. I enjoy the run, but I'd rather have some pressure taken off and have that kind of backup. And I think it's interesting. If you look at last year, 24, 25% return, we had a 10% downturn,
Yep.
right? You look at 2020, we had a 9 and a 10% downturn, even though the market was up over 20% that year also. I think it's necessary for a market that's really going to go to have some periods of time where it's coming down because it kind of stimulates this buying opportunity. And so, a couple things going on in the last, because it's not just today that the market's down. This is the last really month. The market's been at least going sideways to down. We have some up days and what have you that kind of make up for some of these down days. But the same picture has been in there all the way through this, and that is that, inflation is higher than expected, right? Uh, Really, if you look at it, the overall inflation year over year has still been coming down or at least been flat, depending on what measure you look at. So that's good. The Fed still likes that. But what we're seeing is that the month over month inflation for January, February, and March, at least for the CPI so far, has been higher than expected, and annualizing out at around 4%, 4.8%, in that range. And we did get good news yesterday from the PPI. The month over month was only 0.2%, which again annualizes out at 2.4. PPI is the wholesale inflation report. So, that's good. I'd like to see wholesale inflation coming down. Theoretically, it can translate to lower inflation on the consumer side in the end, right? But we'll have to wait for PCE here at the end of the month, which is the favored measure that the Fed looks at. But it's the threat, in my opinion. Everybody's worried last year about recession. I was more worried about increasing inflation, right? And just because the numbers are pretty good, people are out there spending. I think the pandemic and the pent-up demand is really kind of driving things. I saw a really cool headline talking about the 2020s it being the roaring 20s, similar to what we had happen after the last pandemic. So, we have that combination of this artificial intelligence, right, kind of coming up and creating these fantastic profits for some of these companies. We have this pandemic, the pent-up demand, people out traveling, spending money, doing things that they might not normally do because, they were all locked down for a few years or what have you. And, we had falling inflation and the thought process of falling interest rates.
Yep.
And so what's happened now is we're starting to change that thought process. We're saying, okay, maybe inflation isn't going to fall as fast as expected, and maybe the Federal Reserve isn't going to be lowering rates as fast as expected. And so there's this kind of churning in the market because it's already priced in, at the beginning of the year, priced in 6 rate cuts, right? Yeah. And so there's lots of excitement about that because the market loves rate cuts. It just means that businesses can operate, less expensively, right? And so those factors are still playing in. And the factor that's creating the problem isn't artificial intelligence. It isn't the pent-up demand that was driving this. It is the fact that inflation is looking a little bit hotter than it was. The fourth quarter last year, which is where this huge run really got going, I was annualizing out at 1.5% on core PCE, right? And so it was looking really good. And then we've got a difference here. Some of it's maybe seasonal, people doing things at the beginning of the year more than they might at the end. But we'll have to see how that plays out as far as that goes. I want to talk about some other things because we're heading into earnings season, right? And so let's take, this is a great chart that came out of Bloomberg, and this is a comparison of expectations, the red line, for earnings, right? From the analysts, we're always talking about expectations, and then the actual S&P 500 going back to 2012. And you can see there's a fairly good correlation there, right?
Yep.
As the expectations. And so they're saying that, hey, this market's being driven by rising profit estimates. I'll take a challenge on that headline, because if you look real closely at this, chart, it's actually the estimates lag. See that? When the market is hitting a low, the estimates haven't hit that low yet, right? When the market is hitting a high, the estimates haven't hit that high yet. The market leads the estimates.
Yeah.
Right? And so, this is an important point. If you want to become a good investor, in my opinion, pay attention to the movement of the market. It is, it will tell you what's going to be happening in the future. It is a leading indicator. There are 10 leading indicators in the leading indicator index, LEI. One of them is the S&P 500. There are a lot of potential indicators out there. And so the fact that the S&P 500 is in there, I think, is a really important component. And so you want to take a look at the price. And we're heading into earnings season. We had earnings today. Partly the market was coming down because, JP Morgan Chase was, struggling, right? And I was saying that yesterday. I thought the bank earnings probably won't be the thing that really gets things going. But we did see a rally yesterday in the big tech stocks, because that's where I think we're going to see the better earnings come through. The reason that the market leads is because people know what's going on. You can't, there's all these blackout periods around different company earnings reports, but there are tens of thousands of people working in that company, and they can see when it's doing well, they can see when it's doing poorly, and then there is an infrastructure of, of investing companies, hedge funds, mutual funds. There's big money, trillions of dollars in the market, and they're going to spend big money trying to figure out what's going on. So the market's going to move in advance. So this big run that we're having is telling us that things are going to continue to do well. However, you can also get temporary pullbacks on that, right? And so you gotta kind of pull away from the day to day and look at more the long term. So what we look at is what's called a primary trend, right? So when the primary trend is down, we want to be super defensive. When the primary trend is up, we want to be in, right? And maybe we rotate around and we try to capture some of the little minor trends that are happening, but mainly we want to be in. And so one measure of primary trend, and we have a bunch of them actually, is the 50-day moving average above the 200-day moving average, right? So the 50-day in this case is the yellow line and the 200-day is the blue line. And they actually crossed over February of last year, right? And look at how much higher it is now. Matter of fact,
there's a big stretch there.
Yeah, that's why we're coming down, because of that stretch more than anything. We can attach news. We can attach the situation in Iran and Israel, which is scaring the market right now. Yep. We can attach the fact that that's driving oil prices up. We can attach, inflation being hotter than expected. But really, it doesn't matter. The market was already stretched out. Look at that stretch. I mean, where on that chart since 2019 has the 50-day moving average been that far away from the 200-day moving average? It hasn't. Yeah. And so this is normal. We should have some kind of, pullback. One of the other things we look at in terms of primary trend is, are the lows higher? So every time it sets a new low, is it higher than the previous low? And so you can see the first arrow there was October 13th of 2022. And then we had, three other lows, including the one that ended October 27th on our show back in last year. So very much so, primary uptrend intact, no question whatsoever. And so then we take a look at kind of some of the more minor stretch indicators. So this is RSI, right? So this is relative strength index. This is on a daily basis, and we've presented this before. When it gets above 70, the market's considered stretched out, especially on a short-term basis. This is a 7-day indicator, okay? And so you can see at the end of last year, that big spike there, I think we went to about 81 or something along those lines. We're currently at 45.
Yeah.
Honestly, when I look at this is where I get some more calmness, right? Yeah, I know the market's down today and all those things, but I'm thinking very strongly that this is what stimulates the buying to get us to the next level. You need to take the pressure off. You need to have that market kind of coming down for whatever reason. I hope the Israel and Iran thing doesn't transpire, honestly. And that's an issue. In the past, these types of conflicts have always had the same pattern. Market drops at the beginning and then starts to ignore it and goes up. I mean, Ukraine's still going on. When Ukraine first started, everybody thought oil was going to go nuts. It did go up to $130 a barrel, came back down to 70 something, right? And so we've got this scenario now where, again, there's Iran and Israel, and it could always get to be way worse than we're expecting. And so that could affect things. But again, if you look at Afghanistan, you look at Kuwait, you look at, what happened in Ukraine, all of these conflicts had the same pattern, drops at the beginning and then goes up after. It just does. So, we'll see what happens this time, or if anything happens. I think there's enough fear that the market is not willing to sit through the weekend, and people are taking some of their risk money off the table, which is fine. Whatever it takes, this market needs a break, and I think that break will kind of stimulate. So when somebody comes out with great earnings, someplace along in this earnings season, there's some room to go up. And then all of a sudden you got some short covering that comes in, right, in market wise, and then they're all buying when they're covering their shorts. And this is the anatomy of a kind of another move that's going to happen, because we are still in a primary uptrend. We can have a 10 or 15% drop from here, and still be in a primary uptrend, and then eventually, boom, the buyers start coming in. So anyway, that's what's happening this week. I still think this is a fantastic market to be in. It's very sound. Earnings continue to do quite well, in my opinion, especially versus expectations. Expectations continue to rise, and the economy is doing really, considering that we just raised rates 5.2% or whatever it was in total. Really incredible how well the economy is doing as far as that goes. And inflation's going to be a tough one to get down, especially this last bit to get it down into that range. Yeah, and so it'll be interesting to see how the Fed plays this out and what they do. I've been warning that they might not do a rate cut this year, since really end of January, just because I see some numbers that make me think that there's not a real reason for them to do it. Maybe one or two at the end of the year, but we'll see what happens. So anyway, that's what's happening for this week. Thank you for joining, for the summary, and let's get into the questions.
Why is inflation so sticky?
Yeah, I mean, it's kind of interesting, right? I mean, we got a chart that we found. We thought this was really interesting to me. So this is inflation. This is from Yahoo Finance. A little hard to see this, but we'll describe it. It's kind of the categories. Yeah. How much did these categories increase in price? And so the biggest one is auto insurance. And actually, Chairman Powell talking about this in a couple of his Q&As. And so you did a little research on why that's going up, because it's kind of interesting.
Yeah, auto insurance, it's just because they have higher costs in a sense. They're having more claims because of disasters. So any kind of flooding, fires, they have to pay out claims for those. And then also just the cost of repairs have gone up. So if someone gets into an accident, but it's not totally the car, they still have to pay for the repair, and so those prices have gone up. And so just you have to pay more for them just to break even in a sense.
Yeah. So it's interesting. Some of the natural disasters are actually filtering into the auto industry, auto insurance industry. Yeah, you're right. I mean, if there's a giant flood, a lot of cars get destroyed, and of course there's claims on those. It's a little surprising to see it be that high and that much of a jump. But the next two, rent and housing, are related. And I think those are very interesting, because one of the things that happened was that they lowered rates so much that mortgage rates came down to below 3%.
Yeah, and spiked the housing price.
Yeah, it spiked housing prices, right? So it made less people that could afford a home. And then when you're at a 2.7% loan or whatever it is, and all of a sudden now it's 6-7% loan, you don't want to move. So even though the demand dropped down for housing, the supply dropped down also. Yeah. And so the demand is still there, and it's keeping the housing prices up. And so when you look at inflation, it depends on which measure you're looking at. So CPI uses a owner's equivalent of rent, which is a little controversial. But what they're doing is they're taking a look as if you owned that home, how much would you be renting it for? I mean, sorry, if you're renting that home instead of owning it, how much would you pay? And of course, a lot of that has to do with home values and availability of homes. So you're more likely to buy than rent if there's a lot of homes that are available for cheap and mortgage rates are low. So rents have been particularly sticky, and that makes up two of those. Then we got look at that, restaurant meals, personal care. So you're starting to get into the service businesses. Mm-hmm. And so the problem for the service businesses is they're still short on labor. And so when you're short on labor, I see help wanted signs all over the place still. Yeah. That you end up, kind of getting desperate. There's a line of people that want to buy your sandwiches or whatever it is. And so you say, hey, I better pay a little bit more for the next person I try to hire, because I got to get people in here to do the job. And that's still an ongoing issue. There's some relief that's been happening there because we've had a lot of new jobs. So we had 303,000 new jobs last month, right? So that helps. And that's where, it's kind of a funny thing, but the more people that can fill these jobs, it's still over, I think it's around 8.5 to 9 million open jobs, which is still a monstrous number compared to historical. And so that's sort of an unwinding of the pandemic. People that found alternate types of work or aren't working anymore, that type of thing, and just haven't come back into the workforce. And again, people are going out, right?
Yeah.
It's a part of the pandemic. We couldn't go out. Now we can, and so the people are doing it, and so that's part of it. So I think that's what's going to be the hard part here of driving it down. It is interesting at the bottom. So rental cars, toys, airfare, appliances have all depreciated. That's deflation.
Yeah,
that's
and you can
happening
see
there.
that those are more discretionary things
Yeah.
that people are cutting out. Rental care and airfares; those are things you do on trips usually.
Yep.
And if you're not taking trips, you're spending less money. So you can see people are tightening the belt a bit.
Yeah, exactly. So anyway, I think that's a good look at why it's sticky. I'm not sure about the auto thing and where that goes, but rents and restaurant meals, housing, that kind of stuff, that's basic, supply and demand. There's not enough places available. They need to build new residents, and they are. And there's not enough people coming to work at a lot of these service businesses.
Yeah, as long as there's demand and people are willing to pay the price, they're not going to drop their prices.
Yeah, exactly. Yep. All right. What's the next question?
How differently should I invest my IRA versus my non-retirement brokerage account, so a taxable account?
Okay. Really have three different buckets that we always talk about. The taxable account, that basically every time you make a move or if there's an interest or dividend paid or something, you have to put that on your tax return. Then you got your tax deferred accounts like IRAs, SEP IRAs, 401ks, all those things. And again, you don't have to pay anything until you withdraw. So you can make transactions, you can have interest and dividends. Nothing ends up on tax return. The only thing that ends up on tax return is a withdrawal. Right?
Yeah.
And then you have tax-free, like a Roth or a Roth 401k, where it grows tax-free, no matter whether you withdraw it or, you have a dividend or not, all of that's tax-free. So all three of those you might manage slightly different, actually. But the biggest difference is, are you having to account for capital gains all the time if you make a transaction, right? Yes on the taxable side, no on the tax deferred and the tax-free side.
Yep.
And so if you don't have to account for any of those transactions or any gains that you might take, you could be a bit more active, right?
Yeah, depending on your trading costs. If you have no trading costs,
right.
that makes it like you're going to be more aggressive.
Yeah, you don't have a lot of friction. So if I have no tax consequences for selling some, say NVIDIA that I, made a bunch of money on, and I could maybe take some profits, because it's had such a big run or whatever it is that I'm looking at, and I don't have to worry about it ending up on my tax return if it's in a tax deferred or a tax-free account. However, if that is sitting in my, taxable account, it's a really interesting conundrum. It's a good problem to have. I guess they call it a first world problem, right?
Yeah.
You've made a bunch of money on something and all of a sudden, you have trouble to get out of it. So what we do and what we advocate is on the taxable accounts, you want to have your more broad-based investments. Let's say the Vanguard Total Stock Market Index is a great example, right? 4,600 stocks, incorporates most of the U.S. I can kind of buy and hold that.
Yep.
For a long time, and the only time I might really want to do something is in severe downturns and whatever is happening. And so I would have more, even my kind of targeted investments inside of that would still be broader, and then I can take my narrower bets inside my tax deferred or tax free, my targets there, and that's exactly what we do. So the combination. And that's why we advocate having all three buckets and starting to fill those buckets. But the combination allows you to kind of have different investment strategies that can really pay off. Because sometimes buy and hold just works better than the whole trading aspect and the momentum piece. That was certainly true in 2021, for example. If you just own the market, you did great.
Yeah.
If you were trying to find the rotation inside of 2021, it was a brutal year because the rotation was very, very short and very, very fast. And so you were better off just owning everything and just let it go. So if that's your taxable accounts, they're responsible for kind of owning everything. And your tax deferred accounts, we still keep, 50 to 75% of our tax deferred accounts owning everything, very broad, but we'll use more of the the other pieces to go after targets in smaller areas. Again, because we don't have a trading cost on these ETFs, and we at least a commission, and we don't have a taxable scenario when we buy and sell these things. So I think that's a great question. It gets kind of into a refinement of how you want to manage your money, and you can own some individual stocks in your taxable accounts. The one advantage of individual stock is that they're not spinning off uncontrollable capital gains.
Yeah.
They might be sending you a dividend, which you have to pay tax on, but you get to decide. And so you could just buy and hold that for the long term. And honestly, like I've had conversations with clients about NVIDIA, should we be selling some or whatever? At least in that case, it's a big profitable scenario. And you take a little bit of that profit off the table. The government takes some from you, but you still get to keep the rest, right? So there's some advantages to that also. All right. What's our next question?
When comparing funds of the same strategies, what factors should I be looking at to pick the best one?
Comparing funds with the same strategy.
So that'd be like your VTI versus your ITOT.
Yeah. So VTI is a Vanguard Total Stock Market Index, which is their broad-based U.S. And then ITOT is iShares Total Market Index, I believe it's called.
Yeah.
And that is the BlackRock's or version of or iShares version of the same thing as VTI, right? So one thing you do look at is cost, although I would say now cost isn't as big an issue as 10 years ago. Cost used to be a big issue. Now there's been kind of a compression, and the differential in cost is so small. As a matter of fact, I believe those two that we just talked about are identical in terms of cost. However, one thing that does happen is just how many stocks they can have. So there's very few investments or ETFs that have actually the same strategy. There's nuances to that. So just take those two. So VTI has 4,600 plus or minus stocks, right? And ITOT, I think, is around 2,600 stocks. It's been a while since I looked at that. And so what's happening is BlackRock has a higher cost structure than Vanguard because Vanguard's a nonprofit. And all the Vanguard shareholders actually own Vanguard. Basically, if I have VTI, I own that. I own part of Vanguard when I invest in there, and they return their money that they make as profits back to the shareholders of these ETFs and mutual funds by lowering the fee, and so they're very low. And so BlackRock can't compete on that same basis. They can say, okay, we can charge the same amount, but we can't do 4,600 stocks and do that. We could maybe do 2,600 stocks. Now, sometimes you're better off with the 2,600 because it could be those other 2,000 or say microcaps and stuff, and they're just not doing well.
They just don't make a difference.
Yeah, well, they don't make a difference. They do make a difference, but sometimes it's not, because that's the last piece I would talk about there in terms of picking amongst things that look like they have the same strategy is how are they doing? Because that's the biggest piece. So for us, we're looking at it from a momentum basis and which one is kind of rolling right now. And so we have, certain time periods that we're looking back and we compare all of our ETFs based on those time periods and who's moving in that time period. So it might be the last 55 trading days, for example, and who's moving the most. And, our research shows that that momentum would continue, at least historically. And so we want to buy those that are moving the most. So if VTI is doing better than ITOT, then, I'm looking at that, or vice versa. And again, it depends. If this is in a taxable account, I'm not going to get too worried about it one way or another, because it's kind of minor differentials. If it's in a tax deferred or tax free account, then I don't have a tax to buy or sell those if I wanted to move around.
Yeah, because it can get more nuanced in the sense that you could talk about like those targeted mega trend ideas like AI ETF. So you could do bots versus RBO or something like that. There's multiple iterations of these AI, and then you have to start to actually look at the holdings, the cost basis, which ones are running, which ones aren't running, and the holdings actually could make a difference because once you start to get into these more thematic like with they're similar in strategy, you
Right.
could say, because they're the same theme.
Right.
But how they pick their companies is different, and so that's how you kind of have a change in the returns.
Yeah, because that question is interesting. Same strategy. That's what jumps out at me because there's not many ETFs that have exactly the same strategy.
Yeah.
And so in understanding those nuances is my answer to the question more than anything is and so that's where you start to become a better investor. You can understand the nuances of those. They look to be the same. They're both mid cap, right? Or whatever, right? But there's different stocks, different strategies, different fees. I guess the one place you see kind of the same thing is when they're replicating something like the S&P 500.
Yeah.
And so like SPY, which is the State Street, version of the S&P 500 ETF, and VOO, which is Vanguard. They both have the same 500 stocks, should have roughly exactly the same percentages and what have you. SPY has a higher fee,
Yeah,
a higher
so you're
internal
going to take the
cost.
cheaper one index.
Well, except SPY still gets a massive amount of volume because it has really good liquidity, and so the
Spread.
bid spread is really good. So so the traders are using SPY. So again, understanding kind of these nuances, it works out better for them because I think the difference is like 0.03% versus 0.09%. So that's a difference, but you can eat up the spread really quick if you're actively trading that account. So again, it depends on what you're trying to do. There's a reason that that SPY is still out there because of this scenario, and they actually had a lead. VOO didn't come out. Standard & Poor's had some kind of a deal where they wouldn't allow Vanguard to do an S&P 500 fund until 2011, I believe it was, and so some of these other ETFs like the State Street got out there first, and so anyway that. But keep in mind that same strategy. They look the same, they say the same things in their title maybe, but they're, like you said, it's artificial intelligence ETF or something. Wow, those could be really different.
Yeah. Do they have NVIDIA? Do they not have NVIDIA?
Yeah.
What's their qualified to be in their index? They usually set up their own indexes that they run for each of these.
And I would still weigh pretty heavily on how they're doing. Let the market kind of show you what's happening and go after those things that are already moving. At least in the strategies that we use.
What's a strategy to liquidate highly appreciated stocks during retirement to pay for living expenses?
Okay, so that's a pretty common scenario here in the Valley, right? Because somebody works at some tech company, they get all these nice options that grows, and they have, this retirement comes, they have some other assets usually, but they've got this big chunk in this one company. There's a couple of things there. Number one is how much is it as a percentage of your net worth, right?
Yeah, and do you need the money now? Is another question.
I mean, so if it's a lot, you should 10% is the guideline that the CFPs talk about and what have you. I've seen a lot of clients with a lot more than 10%, but I think once you get over 25%, I would be pretty careful. And so that would mean that I'd want to be selling that particular stock. And so you just kind of start selling some on a systematic basis to sponsor your lifestyle. And really, it's complex because you could be selling something that could be worth a lot more in the future. So you do want to be a little bit careful there too. And we use that fruit tree concept with some of our clients where you say, okay, you pick a number, maybe it's 25% of your thing, and that equals, X millions of dollars, of $5 million or $2 million. And so when it gets to, a higher point than what you pick for your tree, you actually pull some fruit off the tree. And you do that every year, every quarter. And so that's a strategy that actually I think makes some sense. It allows you to kind of keep a big chunk of the stock potentially if it continues to do well, if it's Cadence Design or NVIDIA or, whatever, when we look back and think, wow, you would have been able to pull that off to live off of, and maybe even pulling some off to diversify. Let's just say your target for NVIDIA is 2 million and it grows to 2.5 million by the end of the year. And you need, 50,000 to live off of from that particular source, combined with your other things. You still might sell the 500,000 worth, right? Use the 50 to live off. The other 450 just goes now into a diversified portfolio. You still have your $2 million NVIDIA fruit tree sitting there. If it grows again next year, you just keep picking the fruit off, right? And so I do think, from a pure income standpoint, that's one thing. But there are some tax advantages, right? I mean, theoretically, it'd be nice to sell something that had no gain to live off of,
Yep.
cash, bonds, those things. But you can't deplete all your cash and all your bonds. You'll end up with just stocks, and by the time you get older, you have a very aggressive portfolio.
Yeah.
So when you do sell these highly appreciated stocks, we're assuming they're outside of a retirement account, then you'll be able to take advantage of capital gains tax, which are lower than ordinary income tax.
Yeah, so that's a balancing act. So are you taking out, depending on how much income you have, you want to have your tax bracket be essentially, if your tax bracket is below capital gains, what you pay on the stocks, then you want to fill that up. But once you break that threshold, you can then come back and start to take capital gains.
Yeah, exactly. And so it's, you can take ordinary income from your IRAs or 401ks or what have you, or you can take these capital gains, and you want to look at, what you're going to pay to get the money out of each one of those. And sometimes you're kind of forced into it, right? Like when you get old enough, you're forced into taking money through
Yep.
required minimum distributions out of your, retirement plans, whether you need it or not. And you've got that kind of, designates a tax bracket. And sometimes you potentially are forced into selling some of these highly appreciated stocks just because they become such a huge component of your entire net worth. And be very careful of, increasing your lifestyle to match that, because we've seen some phenomenal companies have really big trouble, like GE, which dropped 90%. And so 3M's another one right now that's kind of struggling, right? And
Yeah,
we've
and
seen some
not all
big networks.
companies, there's also going to be rough periods. Companies that have done well. Apple's had their ups and downs
Yeah.
throughout their company.
NVIDIA has had their ups and downs.
Yeah.
Everybody's talking about how great they are now, but they weren't. And Apple they were almost going out of business. They had to borrow money from Microsoft at one point in time, and they're having I guess you'd say they're having a rough spot now. I mean, they're down about 12%
Yeah,
from
their
their high.
corrections
So,
yeah.
right, so that's just the way it goes. That's how it takes time sometimes for these things to work their way out. Not every company makes it back to their high. Cisco didn't.
Yeah, and if you have you could also do options, covered calls to set up a portion of it to automatically sell in a sense, like, that way you can generate some income without actually selling per se until it hits the.
Yeah, what he's describing there is, it's like, say the stock's at $10 a share, you can sell a covered call, let's say $12 a share.
Yeah.
And you actually get paid money when you sell that covered call, and so that could be an income source to you. And let's say that call expires, and the stock never got to 12, and you just got paid. But if the stock goes above 12, then it'll sell that piece.
Yeah.
Somebody will most likely execute that call. Maybe it's at $13 or $14, and they get it for 12, so they're going to take it. So there's some risk there. And, first of all, there's a risk that it's higher when they're selling it to you. And when, if it's at 14, you don't really want to sell it at 12, but you set up this contract basically to sell it at 12. However, it can be a really good strategy for generating some income out of a portfolio. And maybe you need it to sell a little anyway.
Yeah, this is if you decide that, you're going to make a sell on
Right.
these
Yep.
these holdings. So this is a way that you can kind of optimize that selling.
That's right. Yeah, exactly. You get paid while you're waiting for it to hit that price. Hits that price, it's above where you started, and now you sold some, and you've got some more money that you can use for your income. So yeah, there's a bunch of different strategies there. And again, we're kind of covering a lot of area there, because these are simple questions, but there's so many scenarios and so many different things that can happen for each person. It's why it's great to watch these shows, but it's even better to come and to show somebody like us, what you have, what you're dealing with specifically, so we can answer that question in a much more intelligent basis, because, we're kind of scratching the surface of all these different
we're giving a
scenarios.
generic answer to a question that could be super specific to your situation.
Yeah, be careful. All right.
Should I be hunting for a high yield savings account versus my big bank savings account for my emergency fund? And what's a good enough interest rate?
High yield savings account versus the big bank. So the big banks are paying less now, at least in my opinion, because they are the big banks, and especially after this regional banking crisis. Their money flowed into those
Yep.
banks from the First Republics and Silicon Valley banks of the world, because people were worried about those banks going out of business, and so they can sit back now and say, "Hey, we're too big to fail theoretically, and we don't have to pay the high rates because we're in this position." Whereas a smaller bank or what have you is trying to attract money,
Yeah.
right, and they'll pay more. So I think there's no real problem. Honestly, the thing that kind of fascinates me is even though all of those regional banks went out of business, if you had less than 250, you didn't have any real risk. You were
Yeah.
getting paid more theoretically than the big banks, and then the online banks are a whole nother world, right? Because of the lower costs that they have, like Ally Bank and those types of things. And so, what's a good enough rate in your opinion?
So if you look at like the big banks, you're talking about your Wells Fargo's, your Bank of America's of the world, you're probably getting at 1% or sub 1% at best. But then you have your credit unions, which will pay a higher rate, and then you have your online banks. Online banks will always pay the highest because they just have the lowest costs. So if you're really hunting, you could go for something like a Capital One. Ally is a good one. Ally.
And what are they paying, give or take?
Somewhere in the 4.5%.
That's
So in
pretty
that
good.
range.
Yeah.
You can probably, if you're really hunting, you can get something higher, but I like to stay with, more well-known ones that you can recognize.
Yeah.
Like Marcus is one by Goldman Sachs.
Mm-hmm.
Just trying to, you can find these online banks with these high yield savings accounts. You'll get the interest rates, and usually you're not going to draw for them. These are for your emergency funds. So you're going to kind of just stash that money for a rainy day, in a
Yeah.
sense.
Not a bad concept. Okay. Well, that's our show for today. I guess we'll wrap it up there. Really appreciate everybody coming. Some great questions. Send in your questions. We would love to have some chance to look at them and produce some thoughts and some charts and what have you. So you can send them in during the week at asktom@talkmoneywithtom.com. I'll be happy to answer them next week. We'll be back again next Friday. You can go to our channel, subscribe to the channel, hit the bell button when we get notified when we put new content on there. Work on your financial education, and you will have a better financial retirement. Whether you're already in retirement now or you're heading towards retirement at some point in the future, the more you know in this particular area, the more you will be able to kind of insure yourself during your retirement. Because it's not easy. You're going to be living off of your money now instead of actually working in a job, right? So it's a challenge to get there. And of course, you can always meet with us. And so, again, we talked about that today in the show. There's specific situations that you might be in, and we try to give answers here, without knowing all of the details. And so, if you want us to know some of the details, set up an appointment. You can go to our website, book appointment button up on the top, set up a 30-minute conversation. We'll get things started. We can try to answer some of your questions. So look forward to, again, seeing you next week, and look forward to being able to, answer some of your questions. Thank you for coming today.